Hello, Matthew Bell with InsurancePrescription.com. Most people use life insurance for survivor protection, and so in many people's minds, life insurance is synonymous with income replacement. And so as people enter into retirement, many cases their income replacement needs diminish, and so it's natural to think that their life insurance needs diminish as well. But in this video, I'm going to give you 12 ideas for how you can use life insurance even in retirement age, so late 50s on up. And in fact, some of these ideas can only be used in that age interval. Now, first, I should give a disclaimer. I cannot give you insurance advice. This video is for general informational or entertainment purposes only. If you need personalized recommendations and evaluations, you need to consult a licensed professional in your area. Now let me back up for just a minute, because it is natural to think that income replacement needs diminish as a person ages, and for many people and for many couples that actually is the case. But there are income replacement scenarios that can apply to retirement, and the first among these is going to be Social Security replacement. So in the case where a married couple is both receiving Social Security, whoever dies, the survivor will receive the greater of the two benefits, and the lesser of the two benefits will drop away. For some households, the elimination of that lesser benefit could pose a financial problem, and if that applies to your household, you might consider trying to replace that Social Security benefit with a life insurance policy. So idea number one is Social Security protection. But it's worth pointing out that in many cases, the situation isn't that somebody needs to have insurance. It's simply that they want to have it in their portfolio because of some of the utility that it provides to them. And let me give you an example of this. For this, I'm going to talk about the second main use of life insurance besides income replacement, and that is for final expenses, so burial policies and this kind of thing. In another video, I talk about the expectation of cost for final expenses, and it can be anywhere from $10,000, $25,000. I mean, it can be a lot of different numbers really, but let's just think about $10,000, and for more detail you can consult that video. Let's consider a situation in which somebody has $1 million in their IRA, and they think $10,000 funeral expense, that's no problem. The beneficiary of that IRA can simply withdraw the necessary amount, pay the funeral expense, done deal. And of course this is quite true. But if the money is in a fund that is tax qualified like an IRA, then they can't simply withdraw $10,000 and expect to have $10,000 to spend. They're going to have to withdraw a slightly bigger amount in order to settle up the tax liability. So let's pretend like that bigger amount is $12,500. Now, a person with $1 million in an IRA can afford their beneficiary to withdraw $12,500 to have $10,000 to spend if that's what they want to do. Let's look at a different case where a person has put $10,000 into a CD, knowing that there would be a tax liability in their IRA. They have provided a funeral expense fund in a CD. And the person says, I'm not worried about taxes in that account because number one, the interest rates are so low, and number two, I'm 1099 on that CD every year, and I'm keeping up with the tax burden. In this second case, the person's beneficiary can take $10,000 in the CD, liquidate it, discharge the funeral obligation, no problem. So IRA, person spends $12,500. In the CD, they spend $10,000. But it's not uncommon for a person in good health, roundabout in their 60s, to expect that a life insurance payout will be approximately double the premium outlay. Let's pretend like Jane Doe has been underwritten and the actuaries have decided that for $5,000 of premium, she qualifies for a $10,000 policy. The question really boils down to this. Does Jane want to spend $12,500 out of the IRA? Does she want to spend $10,000 in a CD? Or does she want to spend $5,000 in a life policy in order to provide for her $10,000 funeral costs? And in this way, idea number two is to use life insurance as a coupon. Idea number three actually has nothing to do with finances. It has to do with bypassing probate. Because life insurance is governed by contract law, a life insurance policy's beneficiary designations supersede a will and avoid probate. Now, there are other ways to avoid probate, for example, setting up living trust, but life insurance policy does enable you to do that as well. Number four, although this doesn't apply to everybody, and in fact the amount of people it applies to is shrinking year by year, some people have access to a pension through their work. And when they approach retirement age, they're going to be given a pension election form. Generally, the options on that form are going to be to take the money as a lump sum, to take it as a pure annuity with no survivorship, or to elect some kind of a survivorship option. And in most people's minds, the main debate is going to be between a lump sum and some type of survivorship. But if you've decided to forego the lump sum and to rely on the pension, it might be worth observing that in some cases you can maximize your benefit by opting for an option that isn't on the pension election form. And this is sometimes called a pension maximization, and it's a way of using life insurance in conjunction with a pension election to try to get you and your survivor more money with more flexibility in terms of options. Now, it's a complicated idea. To get into the nitty-gritty, I will refer you to a future video that I have planned on the pension maximization, or pension max. But it's worth observing that if you have access to a pension, you might want to at least check to see if the pension max option can help to optimize your situation. Number 5, a life insurance policy sometimes can be used for income generation. Now, this is because some life insurance policies have what are called living benefits. Now, mainly this is going to apply to cash value policies, but if you do have a cash value policy, then you can get cash out of it in a number of different ways. For example, you can simply withdraw the cash it out, surrender the policy. Number 2, sometimes insurance companies will allow you to settle the life insurance policy directly. That is to say, convert it into an income stream. But even where the insurance company does not offer you that direct option, you do have the option to exchange the life insurance policy for an annuity that you can then settle and create an income from. Finally, some insurance companies offer participating policies and pay dividends. And you can elect to receive your dividend in cash every year. And in this way, a life insurance policy can create an income stream in a similar way that you could get an income stream from a dividend-paying stock company. Number 6, life insurance can be used for estate and legacy planning. The obvious application for this is the life insurance policy proceeds are income tax-free to a beneficiary, and that lump sum creates an immediate estate for a son, a daughter, a grandchild, whomever. But this can be used in conjunction with a living trust in many ways. And it frees you up to spend your retirement assets. If you can help it, don't leave your beneficiaries qualified retirement money because you're simply leaving them a tax burden. So don't leave them an IRA, leave them life insurance, because life insurance is income tax free to the beneficiary. Number 7, life insurance can give a boost to your kids' or grandkids' inheritances. So consider again the example I gave earlier where you have $10,000 in a CD. Well, let's suppose that you've understood that leaving money in an IRA is no good because you're going to leave a tax burden for the inheritor. Let's say you have money in a CD that you intend to leave to a child or a grandchild. Well, if you can leave $10,000 to a child or a grandchild in a CD, why not take that money, put it into a life insurance policy that would pay out $20,000 instead? Once again, this is going to depend on underwriting, how healthy you are, and so on. But it's theoretically possible for a life insurance policy to expand the reach of every dollar and help to supercharge your child's inheritance. But for some people, maybe their kids are well heeled, they have got good jobs, maybe they don't have kids or grandkids. In that case, perhaps these same principles can apply to the enhancement of charitable giving. Instead of giving $10,000 to your charity out of a CD, why not use the same money and give $20,000 to a charity via a life insurance policy? That was number 8, supercharging charitable giving abilities. But also number 9, life insurance can help to equalize the inheritances that you give. So for some people, they have cash, they have property, and they want to give an assortment of these things to their heirs, to their beneficiaries. And in some cases, there's a mismatch or a disparity in the valuations. But they don't want to leave the land to all the kids because that poses a problem for management maybe. Maybe only one of them has expressed an interest in renting. Maybe there's farmland and the rest of the kids don't have any interest in inheriting that. Where there's a disparity of value, life insurance can help to equalize a multiplicity of inheritances. Number 10, life insurance can help to provide for special needs dependents. Now, we already talked about trusts, and life insurance can go hand in hand with various trusts. One of the most common trusts to set up is a living trust, and the most common reason to set it up is to avoid probate. But life insurance can also be used in conjunction with special needs trusts. Most likely, if you have a special needs dependent, you are supporting that dependent out of your own income while you are alive. Life insurance can extend the reach of your dollars and help you to support your special needs dependent even after you pass. Number 11, life insurance can help you to discharge debts and other obligations so that you don't pass those on to your beneficiaries and heirs. These could be loans, this could be like a home mortgage. The idea is something that is sometimes called estate conservation. Allow the life insurance to discharge the obligations that you don't have to pay it out of your own assets, and it doesn't have to diminish the legacy that you leave. Now, another way that this works is with taxes. Now, we already said that life insurance proceeds are income tax free to the beneficiary. But life insurance itself can be used to pay estate taxes. Now, there's two related ways to think about this. One is as estate preservation. So think about it this way. You have your estate on the one hand, and you have your life insurance on the other hand. Well, if you owe an estate tax, and by the way, at the time of this recording, the estate tax exemption is 11 million and some change for a single filer and 22 million and a little more change for married people filing jointly. So this doesn't apply to everyone. But imagine you have your estate on the one hand and you have your life insurance on the other hand. If you owe an estate tax, you can think of it as estate preservation in the sense that your life insurance can be used to discharge your estate tax obligation, leaving your estate intact. On the other hand, you can think of it as estate recreation. And in that case, you'd have your estate, you have your life insurance, and after the estate is diminished by having to pay the estate tax, you can use the life insurance to recreate and expand the estate back to its original form. Now that was number 11. Now many of the ideas that we've gone through, in fact most of the ideas, have applied to individuals in individual situations. But life insurance can also have business-related applications. And so number 12, life insurance has applications if you have a business or business connection. So for instance, life insurance can provide key person policies. So if you are very important to your business, life insurance can essentially give the business survivors the means of paying for an employee or a manager to take over your duties in the event of your death and to provide, in other words, for business continuity. But let's say that when you die, you'd be happy to simply liquidate that business. Well, then life insurance can help in that process. And in particular, if there are other partners involved, life insurance can be a part of various cross-purchase agreements that enable surviving partners in that business to buy out your share in the event that you pass so that your surviving spouse can simply walk away from the business. Now, there are many other applications, and if any of these have caught your attention, I invite you to sit down with a licensed professional in your area. But if you found something of use in this video, I invite you to like the video. Click the subscription button. Click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today, and I look forward to seeing you again in another video. Thank you so much.